Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar, IRS Procedural Update, BuySell Development, and Loan Guarantees. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will then try to answer these during the webcast, but if a fuller answer is needed or we run out of time, then I may answer it later via email. A copy of today's slide, as well as other reference materials, are available in the resource widget. You can find answers to some common technical issues located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for a 1.5 general credit, in Missouri for 1.8 general credit, and 1.5 general credit in Texas, which is pending, and in New York, 1.5 general experienced, 1.5 general transitional. We award CLE based on attendance for the entire 90 minutes. From time to time, a pop-up screen will appear asking you to select a secret word. Simply select the word and click Submit. Our system will capture your response. The certification icon located at the bottom of the screen will only tell if you have met our criteria for awarding CLE. It does not include the certificate of attendance. Once we verify your attendance, your certificate will be emailed to you later. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncoburn.com. All in attendance will also receive a link to the recording. Please do not hesitate to share it with other professionals who may find it useful. And of course, if certain parts stand out, then they can fast forward the recording to those parts. We value your opinions and appreciate your participation in the course. So you'll see in the resources that there's a link to my newsletter and also some instructions on how to navigate between my big PDF and the newsletter. It's generally better if you just listen to the slides and then go back later and look. But for those who have to go and look at the supporting documentation, what you would do is you would open up the newsletter, and you'll see in a yellow box in the middle there's a link to my big PDF, and so you would click on that link and download my big PDF, and you'd have the slides open and the PDF open. And then I'll tell you about that. And then when we get to the first instance of a cross-reference to the big PDF, then I'll let you know how you would go and find that. But I do have those written instructions in there to help you out with that. Okay, so today I'm going to cover certain recent developments in tax practice. It's not intended to be a comprehensive overview, just a couple of things that I noticed I think would be of interest. We're going to talk about a recent case on using life insurance to fund buy-sell agreements, which was decided here in St. Louis, but of course could have impact nationwide. And we'll also just, in conjunction with that, just discuss generally life insurance used in buy-sell agreements. And then we'll talk about some recent cases on loan guarantees, because we know that loan guarantees can be very important in estate planning, as well as certain aspects of income tax. So you'll see a couple cases, 2020, 2021, that have some language that may be helpful for you later on. Okay, so on to the materials. IRS developments. I'm going to talk about electronic signatures, talk about describing the effect of superseding returns. A superseding return is a return that you file after the original due date, but before the extended due date. Actually, it could be before or after the original due date, but it needs to be before any extended due date. I'll also talk about reliance on frequently asked questions IRS posts, as well as ASCPA advocacy relating to incorrect IRS service issues. Okay, so you'll see at the top of slide 4, where it says electronic signatures, there's a parenthetical there, 2G20D. So just as the separate handout says, what you would do is you would highlight in the slides the 2G20D without the parentheses, just what's inside the parentheses. And you would hit Control-C for copy. You would go into my big PDF, into the full table of contents, and then in the full table of contents, you would execute a find search, Control-F as in find, and then you would paste that cross-reference using Control-V as in Victor, and then you would hit enter, and it will take you to the place in the full table of contents where I'm referring. And I encourage people to use the full table of contents because that gives you some good context. Okay, so again, what I'm saying here is supported on that 2G20D. So electronic signatures. So we know that during COVID, IRS expedited allowing electronic signatures. And then it had temporary dates, and it kept extending and extending and extending them. And now the IRS is going to allow electronic signatures until at least October 31st, 2023. And the scope of this I'll be mentioning in just a moment. Taxpayers and representatives may use electronic or digital signatures when signing certain forms that ordinarily would require a handwritten signature. So this is very helpful to have. So the next slide has a partial list of forms, and I'm not going to read all of these. I just selected various trust and estate planning forms that are relevant, and that's only a partial list. The 2G20D again has a reference to the full information from the IRS. And then on slide 6, what in the world is an acceptable electronic signature? And the IRS basically says, look, we're not going to tell you what you have to do to have a valid electronic signature, but we will give you some examples just to be helpful so you can feel comfortable with it. So you can see the bullet points here, the type name on the signature block, a scanned or digitized image of a handwritten signature that's attached to an electronic record, a handwritten signature input on a signature pad, an electronic signature pad. And then you can use some kind of a stylus device, or, you know, I would think that like a DocuSign type of technology would be fine, signature created by third-party software. So all of these are good signatures. So this can really help you, you know, if you need your client to sign a gift tax return, you can send them a PDF with the gift tax return and have them sign and scan that first page of the gift tax return back over to you, and then you can just go ahead and use that. In fact, furthermore, you could take that scanned PDF from the client and attach your own digital signature to it. So there's amazing ways that technology can help do this. So you can really do a totally contactless filing process, and so it's really amazing the things that can be done with technology nowadays. So on slide 7, here's some more about the IRS doesn't specify the technology the taxpayer has to use to capture the signature, and then the IRS will accept images of signatures. And again, there's some examples there. These are not meant to be exclusive. They're just meant to provide comfort. All right, so now moving on to the topic of superseding returns. So a superseding return is a return filed after the original return was filed, and that should be and instead of and before the due date of the original return. But again, if you extend the return, then it could be any time between the time you file the original return and the extended due date of the return. So the superseding return replaces the original return. And critically important is that you can change any elections that were required to be made on a timely filed original return. So you prepare the return, file it, and you realize that there was a mistake regarding an election, and the due date hasn't passed yet, then you can just go and correct that and make the correct election. So it's a very helpful process that you can do that. And so what is a superseding return? There's the most recent guidance on it is in Chief Counsel Advice 2020-26002, and that describes the effect on the statute of limitations, but it also has cross references again to what a superseding return is. Now, partnership returns provide a unique opportunity for making this, really showing how useful a superseding return is. So there is this what was it, like bipartisan budget act, whatever, BBA, that was passed in like 2015 or whatever, that was effective for returns that were filed, I think 2018 or so. I don't remember the exact dates of all of this. It's in my materials. You can see it in this 2G20C Romanet 1 up there. And that created procedures for taxpayers who are audited or amend their returns. And the concept for an amended return is that you need to file what they call an administrative adjustment request. So which is basically kind of like you're sending something to the IRS and says, hey, have a live human being look at this stuff and process it and approve it. So that's different than an amended return where you just file it, it's there, it's done. Now, to do an administrative adjustment request that really is effective an administrative, that it really is an amended return, they really have kind of streamlined that procedure to some extent. But you still need to prove that the partners reflected any amendments on their returns. So if you amend the partnership return and you have some numbers that changed, you need to show that the taxpayers' return, that the different partners reflected those amended numbers on their returns. You have to submit proof of that. So that's a lot different than it was before this BBA came into effect. So then you'd have to gather all this information from your partners, proof that they've actually reflected what you've done if you're going to be filing this administrative adjustment request. So that could be a big pain in the behind. So one thing to consider doing is you could extend the partnership income tax return, and then if anybody catches any mistakes on the return, you could amend the return before the extended due date of the partnership return, and that amendment to the return is really not considered to be an amendment; it's considered to be a superseding return, and so then you don't have to follow all these procedures. So you might consider extending the return before filing before the original due date, so you can easily fix mistakes noticed before the extended due date. Now, of course, that will also extend the statute of limitations until the extended due date instead of the original due date. So that is a negative effect of extending the statute of limitations by several months. So it's a matter of what you perceive to be the lesser of the evils. So just a thought of what you might want to do. Some people are interested in it and some people aren't. All right, let's go on to frequently asked questions, FAQs. So, when we think about what taxpayers can rely on generally, there's a question of reliance on two different levels. One is this some kind of a precedent on which the taxpayers can rely and they can hold the IRS to it? So, for example, if there's a revenue ruling that the IRS issues, the taxpayers can rely on that, and the IRS is stuck with that position if there's a dispute with the taxpayer. So now the taxpayers don't have to follow the revenue ruling, but if they want to, they can stick to IRS with it. So that's formal guidance. But informal guidance is not precedent for the IRS. So, for example, a few years ago, they had some instructions relating to IRA rollovers, and the instructions in the IRS's publication said that each separate account counted as a separate IRA, and you could roll over each account. And so taxpayers did it. And then there's some taxpayer got audited, and the court said, nope, just one rollover from any IRA account per year. And the taxpayers actually had to pay tax, and I think they wind up getting penalized too. But this was reliance on an IRS publication. That's the publications that kind of are their informal guidance that they publish to taxpayers. So it's really ridiculous that the IRS says these things in writing and taxpayers rely on them, and then taxpayers can get penalized. But that's the problem with if they don't go to a professional, or if the professional relies on the wrong thing. So for example, when preparing a return, I mean, I would rely only on the law, and if there's an ambiguity in the law, then I would probably use the publication to guide the way I would prepare it, that return. But I would go by the law first, and not by the publication. So what about these frequently asked questions? So the IRS has taken to issuing frequently asked questions in a lot of different areas. Again, just to help taxpayers figure out what to do. The problem is that taxpayers cannot hold the IRS to what these frequently asked questions say, because they are not formal guidance. They are not revenue rulings. They are not regulations. They don't have the force of law. However, the IRS recently threw taxpayers a bone by saying that taxpayers may rely on FAQs to avoid penalties. So let's look at this distinction between avoiding penalties and versus relying on it for precedent. So if it's precedent, then you get to win on the substantive issue on whether the tax is owed or not. The penalties, the issue is, did the taxpayer have reasonable cause for taking this position? And when you're a tax advisor and you want to advise clients so they can avoid penalties, then, of course you have to look at the law, but a lot of times there are ambiguities or holes in the law, and you need to fill those in somehow. And so how would you fill those in if the regulations and the statutes and the revenue rulings don't give you enough guidance? So then you can look at other things like private letter rulings, technical advice memos. You could look at also now FAQs. So the question really is whether the tax advisor got all the facts from the taxpayer and was diligent in doing the research. And so these non-presidential authorities, again, the private letter ruling does not bind the IRS in any way whatsoever, 99.9% of the time. But a taxpayer can rely on it to avoid penalties, potentially, if the tax advisor's review of the law basically has, again, some holes or ambiguities that need some guidance somewhere, and the PLRs might be the only source of that guidance. So that would be a good reason to use that. Okay, so the IRS has announced that significant FAQs on newly enacted legislation, as well as any later updates or revisions to those, will be announced in a news release and posted on irs.gov in a separate fact sheet. And so those fact sheet FAQs will enable taxpayers to confirm the date on which changes to the FAQs were made, so you can really kind of pinpoint that. They said that prior versions of fact sheet FAQs will be maintained on the IRS's webpage to ensure that if it's later changed, taxpayers can locate the version they relied on if they later need to do so. And the IRS might apply this updated process in other contexts, but the IRS didn't promise to do so. Also, if the FAQs were issued before October 15th of 2021, there's no assurance that they will be preserved. So going forward, this would be helpful, but in the past, it's not. Okay, AICPA advocacy, this is a totally new topic. So the IRS is way behind on opening its mail, and also way behind in answering questions. Like it might open the mail, but might not look at what you sent in. And answering questions, so they recently announced the number of calls from 2021 and the number of staff to answer those calls. And I ran some numbers, and if each staff person worked 8 hours a day, 5 days a week, and devoted their entire time to answering questions on the calls, then they could answer all the calls only if they were able to handle 50 calls per hour, 50 calls per hour. They would have to talk to the taxpayer, resolve the question, take notes, write the case, etc. There is no way that they can answer all the questions that come in. So the IRS's service has been really very poor. And I mean, they're underfunded on the one hand. On the other hand, how have they deployed their resources? But what they do is they still have these computers that spit out all these notices. So if the IRS is behind on processing something, and maybe the taxpayer sent in their return and their payment, but maybe somehow whoever at the IRS didn't process both within a sufficient time of each other, then so the system doesn't recognize the taxpayers haven't complied, then the computer will spit out a notice and send these notices out. So they don't really have a delay for the fact built into the system for the fact that the IRS is way behind on stuff, and they spit out these notices, and some of the notices will say you owe money. And they'll even spit out these automatic notices that say, we intend to levy on your accounts if you don't respond quickly enough. And then, of course, when you try to call in to talk to them about it and try to make sure it's okay, you can't get an answer from the IRS because people won't answer it. And also, they've had turnover, and a lot of the people who answer the phones aren't even necessarily authorized to handle whatever you're calling about. So it is a big mess. And the IRS spits out all these notices, which is ridiculous, and then the preparers have to spend time responding to these notices for their clients, which may make the clients think that the preparers aren't doing their jobs, and are the preparers going to charge for their time? I mean, if they do, there's an expense. So, a real easy way to take care of this is, number one, would be don't send out those computer-generated notices right away. Build a delay to the system. Another is to just provide relief from penalties. A lot of these, most of these penalty notices are just totally wrong, and so just be able to ignore them until you actually get a human being who actually issues a notice for penalties. So anyway, the IRS has a lot of stuff it can do to clean up its act. It hasn't done it yet, and AFCPA wants taxpayers to contact Congress for either legislation or to pressure the IRS to change its system. And my newsletter does have some commentary on some information on that and where you can go to find some of those resources. So with that, we're going to go on to our first polling. So today's first code word is sunshine. Please select the correct code word from the list below. While the poll is running, I did have one question about where can I find the updated large PDF. And again, my newsletter is in the resources. You open up the newsletter, you go to the middle of it, you'll see a yellow box. The yellow box has a link to the big PDF, and that will show you the PDF. Okie doke. So now let's go on and talk about buy-sell agreements. There's a section of my materials on funding the buy-sell and on life insurance, and a topic on this segment. So basically, I'm going to talk about life insurance, and then I'm going to talk about estate tax values, which is really the main topic here. So it's really the effect of life insurance owned by a business on the estate tax value of that business. That's the main topic. But first, I want to just mention some life insurance topics that are covered. And so you'll see in my materials, there's something on transfer for value rule and basis. So that's whenever a life insurance policy is transferred, can that cause the death benefit to become income taxable? Income tax issues in transferring life insurance. So I talk about, when you do sell a policy, what would be the gain on that policy? What's the nature of the gain? Income taxation on distributions or loans from the contract. Income tax issues when somebody who's not the owner of who's not the insured died. So, like, suppose a parent owns a policy on a child and the parent dies. What's the basis in that policy? And how do you translate that basis step up and to be able to take tax-free distributions from the policy? It's not as straightforward as you might think. You really need to read that if you have a situation like that. Split dollar arrangements, which most people hate because the law on it is a little complex. But I've got the materials to cover that. Income tax trap for business-owned life insurance, and that's the idea that if a business entity owns life insurance, then they need to, and the policy was issued after a certain date in August of 2006, then they need to have had notice and consent from the insured. So anyway, that's just some background materials on life insurance, just so you can go back and look at that for anybody who's interested in the details on life insurance. But now I want to really get into how life insurance affects the estate tax value of businesses. And by the way, I haven't really seen questions yet, so there is that Q&A widget. So if anybody has a substantive question, go ahead and put it in, and we'll see whether I can get to it. Okay, so here's an example for a buy-sell redemption. So company is worth $4 million. A owns 75% of the company. So A's estate would want to be bought out for $3 million, which is 75% of $4 million. So basically, A's estate would want to ignore discounts for lack of control, lack of marketability, because the idea that, hey, with the death buyout, we really should get a pro rata share of the fair market value of the company. I mean, that's A's estate's goal. It's not to save estate taxes, it's to get money. So, but at the same time, we would like to make sure that that $3 million that A's estate receives is all that A's estate is tagged with. All right, so the company then buys a $3 million policy insuring A's life. So it can use that $3 million that it received when A dies to buy out A's interest. And I have the parenthetical, if able to keep the policy until then. You know, a lot of people will buy term insurance to fund this death buy-sell obligation. And the problem with term insurance is that once whatever kind of fixed rate you have expires, the rates jump and it becomes prohibitively expensive. So you can't rely on term insurance forever. It's only a stopgap until the company has enough money to buy out the person. Unfortunately, a lot of business owners rely on it and don't set aside money to take care of that buyout. If they do set aside money to take care of the buyout, a helpful place to put the money would be in a permanent life insurance policy, because that the cash invested in that permanent policy would grow income tax free. So that's a really good way to invest, to have a source of cash to buy somebody out. Okay, so on A's death, however, the company is worth $7 million because it has its $4 million value as an operating business, and now it has that $3 million life insurance policy in its hot hands. So should the company have to pay 75% of $75 million for A's interest because of this life insurance? Well, the deal was $3 million, not 75% of $7 million. So, you know, that would really not honor their intent to have to bump up the price. The $3 million was the agreed upon purchase price. So what if A's estate gets the $3 million purchase price they agreed on instead of 75% of $7 million? Does that mean that A has bequeathed the difference to the company's other owners? Now, we know that in estate and gift tax purposes, you can't make a gift to a business entity. Instead, you are making a gift to the entity's owners. So if you're essentially making a gift back to the entity, you're really making it to the company's other owners. Now, if you impose estate tax on A's estate for money the estate will never receive, that's certainly an unfair result because it just doesn't get the cash. On the other hand, what if the company's other owner was A's son or some other natural object of A's bounty? Then perhaps A's goal was essentially to bequeath the difference to that other owner. So maybe A wanted to say, you know, look, I own 75% of the company. My son owns 25%. When I die, the company can just redeem my stock for $1. I'm fine with that because I want A to have the whole company. Well, clearly that would just really be passing that 75% of the company out to A. To A's son. So that, I mean, that's a pretty obvious bequest to A's son. So in that kind of case, A's estate should pay estate tax on the difference. Now, would A's estate tax want to recover from A's son? Would A's estate need to recover from A's son? Well, that kind of depends on the deal. On the one hand, because A got all this value, it'd be only fair for A to pay the estate tax on it. But there could be some countervailing ideas. I mean, what if A's blood, sweat, and tears made the company what it's worth, and A's son's blood, sweat, and tears made the company what it's worth, and A just never really got properly compensated for that. I mean, it really wouldn't be fair for A to have to pay estate tax on the value that A's son to pay estate tax on the value that A's son created for A's estate. So in that case, you might want to let the estate pay the estate tax on that. Of course, A would have been much smarter to do some other way of giving A's son that value, and maybe saving estate tax on it altogether. So I had a client where the company was originally worth like $1 million or so, and actually I think it was $900,000 is what they had in it. So it was worth $900,000, and he had to buy sell where his son could buy it for $900,000. The only problem is the company was worth like $3 million. So what do you do with that? Well, the answer would be you get that non-voting stock over to the son. And I mean, one way would be to make a gift. Another way would be a sale to an irrevocable grantor trust. So we set up an irrevocable grantor trust, and I'm sure most of you know this, but just to make sure we're on the same page, an irrevocable grantor trust. Irrevocable means it's outside the estate tax system. Like anything that's inside the trust is not going to be included in the grantor's estate. And grantor trust means that for income tax purposes, the grantor is the deemed owner. So you can do a sale to this trust and not have to pay income tax on it. And these things work magically. It's so good that Congress wanted to repeal it. At least not all of Congress, but the House of Representatives, particularly the so-called progressives in the House, they wanted to get rid of these irrevocable grantor trusts. In fact, they had quite punitive measures proposed. But when Manchin and Sinema were telling Biden that they wouldn't agree to pass it in the Senate, the House dialed back some of those provisions and took them out. And then, of course, Manchin didn't go along with the House bill anyway. After the president acceded to his original demands. So I think all that stuff is dead for the time being. But anyway, the sale to irrevocable grantor trust is basically if you have a pass-through entity like an S corporation or a partnership, and you sell your interest, like for example, you're stocking your S corp to the irrevocable grantor trust. The grantor has to pay income tax on whatever the trust owns because it's a grantor trust. But when the S corporation makes tax distributions for its owners to pay their taxes, the trust doesn't have to pay taxes because it's a grantor trust, and it can use that to pay off the note. So basically, the grantor's note payments are being used to pay the grantor's income tax on the trust's income, and so that note just disappears over time. So the sale to irrevocable grantor trust is a very powerful technique. So what I did for this particular client was I did a sale to irrevocable grantor trust so that Dad had only $900,000 in stock left, and then the balance was transferred to son through the sale to irrevocable grantor trust. And then I also had a mechanism that if that stock grew in value to more than $900,000, then there would be a subsequent sale of that increased value to the irrevocable grantor trust, again, because that note is going to go away and the trust will have full equity. So you need to really deal with a mismatch between the value and the buy-sell, not by playing games with the buy-sell agreement, but by doing sales to irrevocable grantor trust if you have an S corporation or an entity taxed as a partnership. So anyway, I'd rather just avoid the whole estate tax problem to begin with. But let's go on. So when will the buy-sell agreement establish an estate tax value? When can we rely on the buy-sell agreement in the example to say that A's estate will include only $3 million worth, because that's all they're getting on death? Or A's estate has to include more because that $3 million is not really a true measure of the worth, and A is really trying to make a bequest to A's son. So how do you do that? So here's the regulation that on slide 27, slide 22, I'm sorry, which has been around for quite a while. And so when are you going to respect the buy-sell agreement? And it says, well, little weight will be accorded to a price contained in an option or contract under which the decedent is free to dispose of the securities at any price he chooses during his lifetime. So if A could sell the shares for any price that he wants during his lifetime, then we're not going to use that $3 million value that's in our example. So that would also be the case. Suppose we had a buy-sell agreement, and the buy-sell agreement said, hey, even during A's life, A has to sell the shares for $3 million if that's what he's going to sell it for, and has to offer that to the other shareholders. So then you say, well, then it does bind A. But wait a minute. Does A have the ability to change the buy-sell agreement unilaterally? So if A does have the unilateral right to change the buy-sell agreement, then that purchase price is actually not binding on A. I mean, because it really is it's not really anything that A is stuck with. A can change it whenever A wants. It's not really binding on A. The IRS would say, no, you don't get to use that $3 million. Okay, on the next slide, here's some more from that regulation. Even if the decedent is not free to dispose of the underlying securities, the price will be disregarded unless the taxpayer proves that the agreement was bona fide and not a device to pass the shares to the natural objects of the bounty. So it has to be bona fide, and in our example with A's son, it can't be a device to pass these shares to A's son at a bargain deal. It needs to be an intent to make A pay full value. So one of the deals with the buy-sell agreement is you really ought to get an appraiser involved and value the shares. And you should update that appraisal from time to time. That will show the IRS you're not trying to play any games with it. You're trying to do the fair market value and get the full value. So that would be a good mechanism to use. Then the regulation concludes with saying, see Code Section 2703 and the regulations for post-1990 contracts. Okay, so establishing estate tax values. So what about Code Section 2703? So 2703 says that the value of property will be determined without regard to any option or agreement to buy less than fair market value, or any restriction on the right to sell or use the property. So that seems to be just totally bad for here, because in our example, the fair market value of the stock would be potentially 3/4 of the $7 million, not instead of just the $3 million number. But there's an exception, and that nasty rule does not apply if it's a bona fide business agreement, it's not a device that transfer for less than value, and its terms are comparable to similar arrangements. So those first two bullet points were in the regulation already, before and after 2703. But the last one is comparability. How do you prove that? Again, you need to get an appraisal that will so you get the appraiser to say that this was entered into by people in an arm's length transaction. Not that your parties were arm's length, but the appraiser has experience looking at buy-sell agreements of all kinds that deal with unrelated third parties, and these terms are similar to what the unrelated third parties would do. So there was a case called Blount. The buy-sell did not comply regarding restricting the sale during life. In that case, the majority shareholder could have changed the buy-sell agreement, but there would have been some negative consequences on the business, so he didn't, but he could have technically. And the excess value passed to an employee stock ownership plan benefiting non-family members. So in our $7 million example, the estate got tagged with the full 75% of $7 million instead of the $3 million. Tax court imposed estate tax on the excess value. The 11th Circuit reversed, and it said that the tax court. I agree with the tax court that that this agreement didn't affect the value of the shares and the estate, but when you look at this contractual liability the company had, the insurance proceeds were required to satisfy that, and so they basically said that the insurance proceeds could not be included in computing the company's fair market value. And there was a footnote in the 11th Circuit case that basically said because these were third parties, not subject to the bounty, that's why we're taking this position. So there was a case in September called Connolly from the Eastern District of Missouri, again, which is in St. Louis, and it agreed with the Blount tax court, said that the 11th Circuit was wrong. The judge was, of course, said he respectfully disagreed, but he respectfully called the opinion demonstrably erroneous. Well, I'm not quite sure how that can be respectful, but he used polite language and using that invective, but that invective was required because that's what the 8th Circuit said. You can ignore other circuits only if they're demonstrably erroneous. So the Connolly case pointed out that the remaining owner's 23% stock was worth more than the decedent's 77% stock under the buy-sell agreement. Because once you redeem the decedent's 77%, what the remaining owner's stock had was worth much more. And the remaining owner actually was kind of family members. So the Connolly court said, I'm going with the Blount tax court. I'm not going with the Blount Court of Appeals. So I do have questions about this. If the buy-sell agreement is disregarded, will the resulting liquidity also be disregarded? Normally, there are discounts for lack of control, lack of marketability. So in my example, you wouldn't be able to say that A's estate, they're getting redeemed for $3 million. What's the value of the 3/4 of the stock? I mean, maybe what you would do is you would take the 75% of the $7 million in my example, and you would then apply discounts for lack of marketability to it. With a 75% shareholder, there's not a discount for lack of control generally, but you definitely have that marketability as an aspect. And how much control would a hypothetical willing buyer of the company's stock have over that company? So planning after Connolly, I mean, is the Blount tax court in Connolly right? Or was the 11th Circuit right? What's the answer? Well, the answer is, who knows what the court's going to do? Depends on judges. So instead of doing a redemption and having this life insurance come to the company, you're better off having a cross purchase where the shareholders agree to buy out each other. Now, a cross purchase involves risk. What happens if one of the shareholders gets into trouble? They get divorced. They run over somebody with their car. They go insane. They don't want to honor their agreement. So we certainly have seen businessmen who don't honor their agreement. Some of them even can be elected president. Anyway, so I have had in the state where we had a redemption agreement and the company itself didn't honor the agreement. So there's nothing perfect with it, but you have more risk in dealing with individuals than you do with the company because individuals have more risk. Generally, there are many, many exceptions to that. There's also a distortion of basis issue that goes along with a redemption done by an S corporation. I'm not going to get into those details now. You can look at it in that third bullet point at your leisure. So let's go ahead and go on to our next polling question. So today's second code word is blue. Please select the correct code word from the list below. While the poll is running, the question is, I had a question from somebody, if the buy-sell price is thrown out, then shouldn't the death of a key man depress valuation as well? And that's a terrific question, and the answer is yes, you need to look at all relevant factors, including not only the lack of control and lack of marketability potentially, but any other effect that the death of that owner has, and that could be because you're relying on owner's services. You might have been relying on that owner's loan guarantee. Many reasons that the death of an owner might depress a value. They also might have had contacts with their lenders. So now I'm ready to go ahead and move on. Now that I've answered that question, okay. And we're going to move on to the next topic of loan guarantees. So loan guarantees are frequently used in estate planning. So they're used a lot of times if you have a trust that has limited funding and it wants to make a really big purchase. And so it would be good to have somebody who as well guarantee that loan. But you really ought to have some kind of a business reason for it too. So I know somebody who will use the following model. He'll put $5,000, he'll have the client put $5,000 into the trust, and then he'll recommend that his client make a big sale of the trust. Let's suppose that the trust was worth, that the sale would be $10 million. So he would then say there should be a loan guarantee for 20% of that, just to provide some kind of substance for the trust. So basically, the trust would need to go get a loan guarantee of $2 million, 20% of the $10 million sale. And then he'd go get an appraisal to say, well, what would be a reasonable guarantee fee or that $2 million guarantee, and the appraiser he's used, which is a terrific valuation company, it typically will come up with a 2 to 5% guarantee fee. So let's go on the low end just to make things as favorable as possible in this example. So the guarantee fee would be 2% of $2 million. And if you multiply that out, that's a $40,000 guarantee fee. So I said to this person, you are saying that the trust that has $5,000 in it is promising to pay $40,000 next year as compensation for this guarantee, and that makes the guarantee have substance. And the person said, oh, that makes the guarantee more risky. Maybe the guarantee fee needs to be higher. And so he just didn't get it. So we're going to talk about when you might have loan guarantees in estate planning and ways that you don't have an egregious example like that. We'll also talk about how loan guarantees are used in income tax planning, and also, of course, loan guarantees are required by lenders. So, I mean, they are required in the real world, and we're really trying to make our loan guarantees be commercially reasonable. Okay, so we'll talk about gift tax issues involving loan guarantees. Now, loan guarantees are forbidden for IRAs. I'm not going to discuss that here, but it's just in my materials for those who are interested in it. I'll also talk about income tax consequences involving loan guarantees. So on slide 34, the IRS had issued a letter ruling that says that loan guarantees are valuable economic benefits that constituted a gift. There was such an uproar a few years later, the IRS withdrew that holding. And then in 2005, there was a letter ruling where the parent provided creditworthiness to the child, and the IRS didn't even address the issue of the guarantee being a gift. Didn't even think about it. Or at least not that the letter ruling indicated. And the tax court has referred to loan guarantees as unmatured potential claims. I'll talk a little bit more about the legal concept of a loan guarantee, what the true legal effect of these is. But if you're concerned that a loan guarantee is a gift, structure the loan as a back-to-back loan. Parent borrows from the proposed lender and loans money to the child. The parent can charge interest at the applicable federal rate to the child, which is going to be typically a lower interest rate than what the lender is going to charge. The parent can charge the AFR to the child, even though the parent pays a higher interest rate to the third-party lender. Code Section 72 is very clear on that. It's totally legit for you to do this. So if the tax laws allow the parent to charge the child less interest than the parent is paying. I mean, clearly that's an economic benefit to the child, right? That they're paying a lower interest rate than what the lender is charging. So that seems like an economic benefit, but it's not. Code Section 72 is very clear about that. That is not a gift. In the guarantee, the parent isn't even borrowing money from the lender. The child is paying all the interest to the lender. So that's even less of a gift than the back-to-back loan is. So I don't believe that guarantees are gifts. And I'm going to give you another argument for it in another moment. If you can't do that back-to-back loan, if that's impractical, you might consider paying the parent a reasonable guarantee fee just to try to give a business purpose for the guarantee. Now, what about a loan guarantee by a trust? With one trust guarantees a loan of another, so that borrower trust can go ahead and buy an asset with a note. So there's a kind of a two-pronged thing. The first one is, can the guarantor trust actually make the guarantee? So one is, it's nice to have a provision in the trust agreement allowing credit to other trusts for the benefit of the trust beneficiaries. So you have guarantor trust for the benefit of child and borrower trust also for the benefit of the child. And the guarantor trust says, the term of the guarantor trust says, if the child or any trust for the benefit of the child ever borrows money, it's okay for the trustee to guarantee that loan. The borrower trust might not even be in existence, but it is described in the idea of a trust for the benefit of that child. Charging a fair market value guarantee fee would also give the guarantee business purpose. Obtaining the beneficiary's consent would also generally be okay. I mean, that would at least get the trustee off the hook. And if the interest is at least the AFR, or the lender is an unrelated third party, then then that may be fine too. Now the next slide is really busy, and I'm just going to kind of run through this. So the idea here is you set up two trusts, and this is really most frequently used in a beneficiary deemed owned trust. So in this beneficiary deemed owned trust, let's say mom is creating this trust for the benefit of the daughter. The mom puts in $5,000 and gives the daughter the right to withdraw that $5,000, for example, within the next 30 days. And daughter is the trustee of this trust for daughter, and daughter puts some money in a non-interest bearing account, and then after 30 days that withdrawal right lapses, and under the tax laws, Code Section 678, parentheses A, parentheses 2, one can take the position that the daughter is a deemed owner of that trust, and it needs the $5,000 is kind of the most you can use on this, because any lapse of withdrawal right that exceeds that would be a gift to the trust, and we can't let the daughter be a gift of the trust for the grantor of the trust for her benefit. So I mean, she can't make a gift to the trust for her benefit, or it will be included in her estate. We want this mom to be the only one who's the grantor or settlor of this trust. We don't want daughter to be that, because then it would be including daughter's estate. So we keep this amount under $5,000, and then you have that withdrawal right lapse. But this trust is pretty thin to buy something. So mom goes out and puts, for example, $1 million into a separate trust for daughter's benefit, and that trust is identical to that beneficiary deemed owned trust. So the $1 million trust has the same beneficial terms as the $5,000 trust. So then that $1 million trust could guarantee the loan when that $5,000 trust buys the property. So this is a transaction that we'll do from time to time. And what's the business purpose for this loan, for this guarantee? Why should the $1 million trust guarantee the $5,000 trust? Well, even though for commercial law purposes, a lot of times they will treat trusts as if they were entities. When you go to the heart of trust law, a trust is not an entity under trust law. A trust is a relationship between the trustees and the beneficiaries. And the trustees have a duty to promote the beneficiaries' interests, their beneficial interests. So basically, the trustee has a duty to promote this relationship between the trustee and the beneficiaries. And the trustee of the $1 million trust has the duty to promote the relationship between the trustees and beneficiaries. And it doesn't matter where the account is held, or what account is held at, what the legal structure might look like, or whatever. As long as it's the same beneficial rights, the trustee of the $1 million trust has a duty to promote getting money into a similar arrangement. So when the $5,000 trust has this opportunity to increase its value and do so doing a really good deal, because being deemed owned by the daughter, the trust isn't going to be paying its own income taxes. So that's a really good deal for that trust to buy this asset from the daughter, and have the daughter pay the income taxes that's generated on this $5,000 trust in the future. So buying, daughter being able to sell the trust income tax free, and daughter paying the taxes on that trust forevermore. That's a good deal that the trustee of the $1 million trust wants to promote. So the trustee of the $1 million trust arguably has a fiduciary duty to guarantee that loan. So that's the logic that we have on slide 37. Income tax issues involving loan guarantees. So a guarantee is not a payment for income tax purposes. Instead, when the lender forces the guarantor to make a payment, the actual payment is a loan from the guarantor to the borrower that the guarantee agreement requires to be made. So basically, the guarantor is stepping into the lender's shoes. So the guarantor pays the lender, and the lender basically says, all right, here's your right to the loan. You go try to collect this thing. So that's really when the loan has been made. So I've got here a section on income tax issues involving loan guarantees. So C corporation shareholders prefer to treat advances to corporation as debt, so they can extract money without being a dividend down the road. IRS has had disputes over whether advances are debt or equity, and there have been there's been at least some case where the shareholders' guarantee of a corporation's loans were characterized as a loan, followed by the shareholders' contribution of capital to the corporation. So you'll see in my slide, there was just an argument going on. I'm not going to spend time on those details here. I just want you to know that in a C Corp area context, loan guarantees have caused shareholders to get in trouble. S corporation, basically, what if the S corporation is generating a loss? The shareholders can deduct that to the extent of their basis. If a shareholder guarantees a loan made to the company, does that guarantee count as basis? After all, the shareholder is assuming that risk of that loan. And the answer is no. You have to have a back-to-back loan. The shareholder borrows from the bank, and then the shareholder loans the money to the company. When the shareholder loans the money to the company will give a security interest back to the shareholder, and the shareholder will then assign that security interest back over to the lender, back to the bank. So you need back-to-back loans instead of a mere guarantee if you're a S corp shareholder and you were to deduct losses against your basis. Partnerships, again, to deduct a loss, you have to have basis. But in a partnership, what happens is the partnership's debt, and my main partnership includes an LLC tax as a partnership. So the partnership's debts are attributed to the partners, or again, if it's an LLC, that would be members. But these debts are attributed to the partners, and they can write off their losses against that debt that's attributed to them. So how do you allocate the partnership's debt to the partners? And the main question is, who's at risk for those debts? So loan guarantees can help determine how that debt is allocated. Because if one partner is guaranteeing a debt and another is not, then arguably the one who's guaranteeing that debt has the risk of loss, and so that liability should be allocated entirely to that partner. Now, there's a whole bunch of complicated rules going over this. I'm not intending to go through those complicated rules and, teach that part to you. I just wanted to let you know, that the guarantees can affect the allocation of debt. There's also something called the at-risk rules. So the partner has to have the financial risk of loss in order to be able to deduct that loss. So they have to have not only basis, but risk of loss that accompanies that. And again, a guarantee would substantiate that risk of loss. So in the partnership income tax arena, loan guarantees are very important in allocating debt to support losses, and also in satisfying these at-risk rules that require the partner to have economic risk of loss. And so you have taxpayers, writing off millions of dollars of losses based on these loan guarantees, and the IRS will fight about it. They'll say, we don't want to allocate these losses to this high bracket taxpayer. We'd rather disallow the loss or allocate it to somebody in a lower bracket. So the IRS fights on these things all the time. And they've had some regulations that they've promulgated that outlaw what they call bottom dollar guarantees. So those are guarantees that really the bank didn't even need the guarantee, but they were just put in there for tax purposes. And the bank is never ever going to really have to look to those ever. So that there are some regulations that say that if you have the so-called bottom dollar guarantees, we're not going to honor them. So there's a lot of litigation that goes on it, and there's nothing really in the estate tax arena that says when a guarantee is real or not. So a lot of times with business issues, like issues relating to businesses, if there's no estate and gift tax law, the courts will look to the income tax treatment and see what the IRS says there, or what the courts have said there. And they'll carry that over to the estate tax area. All right, before I move on further, I'm going to do the last polling question. Today's third code word is plain. Please select the correct code word from the list below. And while we're running the poll, I had some questions. One person asked, what are your thoughts on the $1 million trust funding the $5,000 trust itself? And the answer is that would not work to achieve the daughter being the deemed owner of the entire $5,000 trust, because she would have had to have the right to withdraw the entire $1 million funding. I had somebody else questioning about code section 483, which is not a gift tax section; it's an income tax section. They're asking if a guarantee is not a gift, what does 483 mean? So what I do is I look to the regulations that again support Code Section 7872. Code Section 7872 refers to interest rates, which are the applicable federal rate, the AFR, under Code Section 1274 parentheses D as in dog, and the code sections 1274 and the ones that surround it, like 1272, 1273, 1274, 1275. So when you go and look into those code sections, they say that basically we respect a loan if we don't care about the the borrower's creditworthiness, you can use AFR regardless of the borrower's creditworthiness. But you have to have a reasonable expectation of repayment. So when the regulations say that, that's what I stick to. You need to have a reasonable expectation of repayment of that loan in order to be able to use 7872. But if you do have that reasonable expectation, you can use the AFR. If you don't, then the second gift tax purposes would not consider a bona fide loan anyway. So that's my story. I'm sticking with it. You have to have this reasonable expectation of repayment in addition to having the guarantee. So the guarantee is not a gift because creditworthiness, the lending of creditworthiness is not a factor in determining what AFR to use. Okay, I'm going to go on to the next part, and then I may go back to some questions after I get done with these. So the question is, about, again, when do you respect a guarantee? And the IRS really fights hard on this. If a court is going to uphold a guarantee for income tax purposes, there's a very good chance that if the court had the same situation and was asking for estate and gift tax purposes, that the court would take the same approach. So I've got some quotes here from some recent tax court cases. So these may be helpful if you're ever arguing with the IRS about whether to respect the guarantee. You might look at these. Again, even though I'm mainly gearing things towards estate and gift tax planning, there's no other place to look other than the income tax cases. So here's some good language with the income tax cases. So you can see here on slide 43, we look for the guarantee. We look at the fact and circumstances to see not only whether there's a right to reimbursement, but whether the substance of the right is meaningful. So is there a realistic possibility that the guarantor would ultimately be subject to economic loss? So that'll determine whether the guarantee was real. And then they talk about what happens under this particular at-risk rules. That's what this 465 is those at-risk rules. You have to be financially responsible. And so then you look whether the primary obligor defaults, and then the guarantor has to pay. And so it would be inappropriate to say, well, the guarantor can go back and try to collect the money back from the borrower. So that doesn't mean, just because the guarantor can collect back from the borrower, that doesn't mean that the guarantee doesn't have substance. I mean, the guarantor still has to come up with the money. And a lot of times with guarantees, there are different types of guarantees. Some of those require the borrower to go after the lender first. Other times, they even set up the guarantor as if they were a co-borrower. And they say, we can go after anybody, and you don't have to even prove a default. If the lender wants the money, they can just make the guarantor pay it. Now, they are looking to the borrower to do the payments. That's what's expected. That's who the note is with. But they will list the guarantor as a co-borrower to try to go after them easily. So there are different types of the guarantees, and we're going to see a case to talk about that in just a moment. So slide 45, here's a person who is directly liable for the full amount of the debt if the borrower is defaulted. So the tax court said, we're going to respect that. He was at risk, personally liable, not protected against loss, ultimately at risk. And here's another on slide 46. And going on to slide 47, there was no loss protection for him. There's nobody, he couldn't go after somebody other than the borrower to help him out, to pay this off. So there were no other borrowers, no other member was personally liable for any portion, so that person was liable. Again, it's not whether you can go after the borrower, but whether you can go after some other person who you have to make pony up the money. And if there's nobody else who you can make pony up the money, then you're truly the guarantor. Now here's another case in 2021. And here it says, we will not invalidate the collection guarantee simply because the lenders must seek payment from other potential sources before turning to the guarantor. So if the lender has to go through certain remedies before going after the guarantor, that doesn't make the guarantee less real. That's just a procedural thing. The guarantor is still on the hook. So similarly, what if the borrower structures debt to mitigate the risk of default? Maybe there's a low risk of default, so the guarantor might not be at that greater risk. Nevertheless, if the borrower defaults, the guarantor is on the hook. So the guarantor still is considered to be liable for that. And then here on slide 49, again, the guarantor would shoulder the ultimate economic burden of the debt. So the IRS said there were certain requirements relating business to business purpose, and claimed that there were no real world consequences. But as in fact, everything was followed and by the taxpayers, and the guarantee eventually got respected. Didn't even matter about financial reporting statements, because financial reporting may measure the likelihood of payment, but it still doesn't measure the fact of the bottom line guarantee. So if there's, like if you have the financial statements and there's a 20% chance of having to pay $1 million, then you would tend to record on the financial statements $200,000, because that's the expectation, 20% times the $1 million. You would still put in a note that it's $1 million is being guaranteed, and that's how you came up with it. But you would show $200,000 on the financial statement in that example where you really have $1 million guarantee. So just because the financial statement showed a smaller amount or might not have shown anything as a liability, that still doesn't mean that the liability didn't exist. Okay. Last quarter's newsletter paid a lot of attention to whether a loan modification constitutes an exchange. So since we were talking about guarantees, I just wanted to point out that if you are going to do any kind of loan modification, there are potential tax consequences to that, income tax consequences. And many of you may be aware that the standard that was used for many commercial loans is something called LIBOR, London Interbank Offering Rate, or something like that. I might be misstating it slightly, but LIBOR was the benchmark. There were some serious problems with the way that LIBOR was being calculated and handled, and so LIBOR is being done away with, and they have various substitutes for that. So the question is, we have this commercial reality that exists. It used to be LIBOR, now you're using something else. Is that a modification? Well, I mean, it is modifying the basis for your interest rate, so in some ways that's a modification. But is that something that's really so significant that you've really considered to swap in your old note for a new note? And the answer is no, it's not. Because you got to have some benchmark, and your new benchmark is trying to take the place of the old one, because, again, you just have to have something. So there's some regulations that talk about the fact that the change from LIBOR to some other rate generally is not going to be considered to be a swap. So you're not considered to have had any consequences of having your note paid off and then a new note taken out. So I'm going to do my conclusion slide quickly. I'm going to encourage people to do evaluations, and then I'm going to go back and answer some questions. So here's my conclusion slide. For further resources, here's my I have some things for CPAs if they want to get free CPE. These various webinars are available live for CPE, or anybody who wants to listen to them. They're archived, they're accessible for free. So if you want to know about fiduciary income tax, or want to see some of the other offerings I've had for free, you can go back and look there as well. I have a blog, the reports on Heckerling. Heckerling was going to be the week that included January 12th, and the in-person Heckerling got canceled, but Tina is having a lot of the speakers come back and have a virtual Heckerling, and the virtual Heckerling looks like it's going to be the last week in March. So the ABA Rippity has people who report on Heckerling. If they do these reports on the virtual conference, I don't know whether they are or not, but if they do those reports, I comment on those reports, and you can see those reports and my commentary on them. And you can see there a link to subscribe to my newsletter if you don't already subscribe. April 26th will be a webinar for my first quarter newsletter. And then I also do have a session on fiduciary income tax that I'm doing with my partner Laura Duncan later on this month in February. So that fiduciary income tax refresher for CPA Academy, that's for CPAs. For those who want to get COE like this, you'll hear that at the later on in February. There'll be an announcement for it. And finally, at the bottom of that webpage, there's a link to other free Thompson Coburn resources. So I encourage people to sign up for that. So be sure, after I'm done answering these questions, to complete and submit the survey that will display at the conclusion of the webinar. I really appreciate people logging in. We've gotten a really nice following. So let's look at some other questions. Wouldn't the risk of a cross-purchase agreement be obviated through the use of trust ownership of insurance policies? One thing which I meant to cover that I didn't is the use of not a trust so much, but a life insurance LLC. So let me go back here. Oh goodness, that slide didn't make it into it. So what I like to do is, when there's a cross purchase going on, I will have an LLC hold the policies, and the manager of the LLC is instructed to sit on those policies, sit on the death benefit until everybody has agreed on the buy-sell, and they're going to use the life insurance to do that. So that's my way of mitigating against the risk. Often the manager of the LLC that holds the life insurance policies is the company's CPA, because they have a full understanding for what's going on and can help manage the life insurance, accounting for the life insurance payments. So that tends to be my preference, but you can have other people as well. So we have reached the witching hour. Again, thank you for participating in our webinar, and please complete and submit the survey that we'll display right in just a moment. Thank you.